Very good. Tom, thank you very much for the wonderful introduction. Just so I can get a feel for the room, can everyone raise your hand if you have, this is going to be an easy one, so just bear with me here, if you hold real estate hard assets outside of the traditional paper that we're talking about today? You own a home, you own hard assets. Great, thank you. If you could raise your hand if you actively manage a portfolio of securities, could be debt or equity instruments, could be for yourself or for a retirement account or for a spouse, friend. Great, so we're all pretty much on the same page. And then finally, and this will get back to one of my final points at the end of the conversation this afternoon, who's been to Tennessee before? So we do have a few first-timers. All right, great. Let me start by sharing that I do recognize and I understand the challenges in the industry, which include, but aren't limited to, lower primary market issuances, lower interest rates leading to crowding or dense primary markets, and the move towards securitization. The final challenge, I understand, is inherent. I recognize that I literally stand between you and lunch, so I will do my best to make my comments concise and enjoyable and make sure that lunch is not cold by the time I'm done. To be fair, I was allotted 2.5 hours of time, and I plan to use no more than 45. Thank you. In the coming minutes, I'm going to propose some theories and observations from other asset classes which you may be able to translate into this very specific asset class. There are 5 themes that I plan to cover today: diversification and portfolio management, the adage of plan your trade and trade your plan, the theme of having access, and I realize access can be a brand, but we'll say small a access for this item, and the last 2 brief comments on the regulatory environment, and finally, technology as a trend. Through this dissection of these themes, I plan to challenge you to consider how some of these alternative perspectives may add value to your business and, more importantly, the performance of your funds. Provided we have the time, we can also discuss further investment opportunities in the real estate industry, namely interest rate and lien tax observations that I've made, along with ongoing consolidation in the hotel industry. If people really want to twist my arm, I'd be happy to talk about that topic. And finally, the recent shift in large brick-and-mortar alternatives and the retail space in particular, as I'm sure you all saw Macy's challenging report yesterday and front cover of the Wall Street Journal today. First, some general themes. I'm pleased, of course, to be here and to speak with you this afternoon, or I guess late morning, and appreciate the efforts of Tom McCosker and the BCMG team to make it possible for me to be here today, so I want to extend my thank you to them. I do appreciate it. Further, I'm always excited to be around fellow asset managers, and particularly those who many of us affectionately refer to ourselves as alternative asset managers. It's been my experience from working with individuals like yourselves that we tend to be the problem solvers. This is not vanilla product. This is not a simple buy and sell. We're working through problems. We see opportunity in challenges. Perhaps not as well in this room, but some people buy and sell products such as cars and houses and private and public debt every day. They may not be as sophisticated as we are. They may not be able to get the same deal that we do or the same terms, but at the end of the day, these assets that trade hands enable someone to buy a car and get to and from their work or buy a home and have a place to live. In the end, both parties, both the, if you will, the vanilla everyday buyer of common assets and the more exotic role perhaps that we play in this alternative asset class, align and arrive at the same outcome. They're deriving value from a product, and we're providing liquidity to a marketplace. Before I get into the tax liens in particular, I'd like to share how I first got into investing in tax liens and how I started in investing in general. One last, well, I can't promise that. This will be my 3rd or 4th question. Just a show of hands, do I have any golfers in the audience with me? A few? Well, then the ones that aren't, bear with me just for a few seconds. The importance of being good to your caddy is represented by my role here today. I started out as a golf caddy. I started caddying for an individual who was an equity trader on Wall Street, and he instilled in me many of the spirit and disciplines that I have today. What he also instilled in me is the importance of moving through your golf game very quickly. And in honor, I was thinking of veterans, and in honor of our veterans yesterday, if you were ever out in a golf course and your caddy starts humming Army tunes, it means you're playing Army golf, and please pick up your ball and move on. As a junior caddy back in the day, I know I would have appreciated it, and he'll probably appreciate it as well. During my years of high school is when I caddied on a golf course on Long Island. I enjoyed learning from some traders the importance of diversification, as well as finding companies which had the best value for their customers and investors alike. I used capital earned from caddying to open a trading account and started investing in simple, straightforward growth companies like Walmart, Callaway Golf, just at the time Big Bertha was making its move, its expansion, if you will, and finally shares of Apple, which I still have the stock certificate today, although I have to admit I did sell the shares. Somewhere, I continued to invest throughout high school, stepping out of class to have my mother place the trades for me because she was my custodian. That didn't work out as well as I had hoped. As a freshman in college, I used the proceeds from my Walmart investment to purchase my first laptop and let all of the other investments roll. Shortly thereafter, a close relative got into the tax lien industry. And we started a very interesting conversation. He was investing in Colorado in particular, and he allowed me to invest alongside him. My first investment probably lasted less than a year. I know it was definitely less than a year. And I allowed that investment to roll a few more times during my years of college. I'll put my hand up and say the only reason why I stepped out of the industry temporarily, ladies and gentlemen, was because this was the dot-com boom. And I found many wonderful opportunities, as I'm sure you all did as well, to hop in a dot-commer for a few hours or a few days or even a few weeks. That's long-term back then, right? And that's how I was able to best position and best use my capital during college. Shortly after, when I was in college, I had internships at the NASDAQ clearing side in the Standard Oil building on 26 Wall Street. That's right across from the Big Bull, as you probably know, and that taught me a great appreciation for the challenges of operations. This was back in the day, of course, when you actually recorded the conversation between the investor, as you still do today, but what I'm trying to refer to is many more conversations were taking place by phone as opposed to by the internet. So there were usually some investors that would try calling up the day after the trade and saying, oh, you misquoted me. I meant to buy MSSSS as opposed to Microsoft. And obviously Microsoft went up and that stock went down. They wanted to trade it back. So I appreciated and went through the challenges of what clearing and operations went through on a daily basis. Walking into my senior year, I had an internship at Morgan Stanley, and I made the biggest trade of my life. And that trade was I decided to go the route of accounting as opposed to finance. The dot-com boom was becoming a bust very quickly. It seemed rather prudent of me to follow the path of finance, accounting as opposed to finance, and I'm very pleased that I went in that direction today. After graduating college, I started at Deloitte & Touche, as Tom referred to earlier in the opening comments, in the banking and securities group, and I maintained an active and trading pattern throughout. I was unable, of course, to continue trading as I became part of management, and so shortly after I got married, I looked for the opportunity to shift, and the opportunity to shift or pivot came when one of the clients I was serving in a nonprofit pro bono status, if you will, was looking to stretch out. They were in retail banking for 70 years on Long Island. They wanted to move into commercial services and merchant banking. I had been serving the advisors and the board for about 3 years at the time, and when they asked me to step outside of Manhattan, changed my commute from an hour, including a train and a subway, to 2 miles away from my home. I hope all of you realize it was a very quick decision. Upon completion of the initiative, I recognized that the time for business school was quickly closing as it relates to opportunity cost, and I pursued my lifelong goal of attending Harvard, except on the other side of the river. Anyone here from Boston? Just a quick show of hands. Anyone Boston? I'm not going to offend anyone. Well, I did see a half a hand. I know the individual, so if I offend you, I do apologize. We're on the south side of the Charles River, the business school that is, the undergrad, as well as the law schools on the north side. They're the more progressive side. We tend to find ourselves the more conservative or rational. That was sort of a punchline. I'll let that just sit there for a few minutes. During my time in Boston, the framework for my private company, Kernan Capital, was finalized, and the first fund was launched in 2011, squarely on the basis of this is what I've been waiting to do my entire life. This is what I'm best at, and if I don't take the opportunity now to step into the marketplace, I never will. So quickly on Kernan Capital, Tom outlined it very well. It's an equity long-short fund. Almost all of the positions are U.S. equities, some very small concentrations overseas. It's a closed-end fund, which, as all of you know, simply means that once my day one investors are in, they're welcome to leave, but then I open a new fund for new investors to come in. I'm proud to share I have 100% of my day one investors, and we are long past our lockup period. So it has nothing to do with them not being able to remove capital. It's more a function of the value that Kernan Capital is bringing. So now I'm challenged with the biggest question on the table right now, and the question I'm sure all of you have on your mind. What can I share with you that you don't already know as it relates to trading and portfolio management, especially as it relates to the evolving real estate market and the myriad of its related products? Since many of you are experts as it relates to managing tax liens, I'm simply going to attempt to challenge you on some of the most recognized portfolio management themes and concepts, and therefore encourage you to look at your individual holdings and portfolios from a different viewpoint. I'd like to challenge some of the basic philosophical beliefs as it relates to general investing, themes, and paradigms. So the first point, diversification. We all appreciate the value of diversification in assets and asset classes, even within a single class. So let me just give a quick example. What is the safest of all assets? Not everyone at the same time, please. Treasuries, and what are the basis of treasuries? Cash, right? We're on the same page. Treasuries, cash. But not all cash portfolios are traded equally, right? You can have basic cash in the bank account, treasuries, money market, and we're now talking about US dollar. Your denominations, of course, are global. So perhaps the best idea for all cash encompasses every instrument I just referred to. And at the end of the day, what are we really talking about from someone who's holding just the cash portfolio? It's that pesky little component called inflation that we are all so worried about and arguably is inevitable in the coming years. So now I've actually challenged my original paradigm, haven't I? I've suggested that you should diversify against asset classes, whereas I should have shared earlier, the positions I take in my funds are very concentrated, long-term holding positions, which means some of the original positions I had back in 2011 still exist in the portfolio today. I focus on small and medium-sized growth companies and hold them for years as opposed to days or weeks or hours for some day traders. The takeaway here is I would encourage portfolio theory to continue the dissection of concentration risk, and further would encourage you to attempt to manage down that risk via strategic and thoughtful discussions with your team and portfolio manager to ensure that you're not overweight. And I guess in many instances that would refer to overweight in a particular state or a particular region. From a portfolio management perspective, the deeper question is, what is the portfolio, of course, designed for? I imagine all of you have very specific, defined terms and objectives for the portfolio. If the answer is simply to build wealth and diversify away from other asset classes, namely hard real estate holdings and publicly traded equity and debt instruments, then I'd say great, because you're setting yourself up for larger opportunities. Why? Because we all recognize that on any given day, a lien or a portfolio that we'd like to get a piece of. Therefore, I'd encourage you to hold a piece of your general portfolio aside for trading, in which I maintain at Kernan Capital. I imagine a majority of you do as well. You have your core objective, you have your core holdings, and you hold a portion of cash, 5, 10, 15% aside, to trade around, to help increase that alpha, of course. I'd like to spend just a few more minutes on this topic. I'd like to propose those of you who make long-term portfolios do so in a manner that trades around the challenges that we expanded on earlier in the conversation. Having capital snap up opportunities in your core competency is critical. That's what we do when the markets are down in debt and equity instruments. But also having capital set aside to pick off positions outside of your core competency, perhaps in a new state or a new region, would bring new insights and new opportunities to your portfolio, and perhaps also shift new opportunities for the future and where you may focus. However, in order to successfully trade around core holdings, it's critical that you plan your trade. Once it's understood you have some capital on the sidelines, knowing the market and having the right partners is critical to your success. Trading by nature suggests that there's a shorter time horizon, thus a very different approach instead of metrics compared to your normal approach. This is where the adage, plan your trade and trade your plan, comes from. When I'm in a trading mode, and ladies and gentlemen, that's incredibly rare for me, it means I have a lot of components in the marketplace that have aligned or at least appear to run in parallel. As I imagine most, if not all of you are doing already, I get on the phone and I speak with those geographically farthest from where I am first to remove the news bias. And the perfect example I'll give is I spoke to a client this past summer, July, August, when the equity markets were getting really crazy, really fast. And I'm sure you all remember this day when the Dow futures were clicking off 100 points, 200 points, 300 points, 400 points, 500 points. I was sitting in front of the screens. And to give you an idea of how often I trade, I placed 12 trades all of last year. This is not an active fund. This is a very concentrated, long-term, long-focused fund. When the Dow futures are off 500 points at 9 o'clock, and you know you have 30 minutes to get the full liquidity that you want in the market to actually get out of a position or perhaps buy a new one, any manager says they're not nervous is lying to you or is on something that you probably want or don't want to try. The investor called me, and he was in Croatia, and he was vacationing. And his only question to me was, how low can I buy Apple today? Can I get it below 100? Can I get it below 98, 97? He did. He stepped in. He had the cash on the sidelines. The point is, if I would have called, likely, most people in New York or on the East Coast, at least at that time, they would have talked about what's happening in China, in Asia. That's mindful. It's important. What's happening in Europe, what they heard about in London, what they heard from the floor and their guys on the stock exchange. And they would have had all these biases come in that there's actually more fear in the market than there really was at that point. Apple, I guess, traded around 116, 117 yesterday. If, in fact, the market is going lower, I don't have a crystal ball, none of us do, that's all right. This client already picked up 20 points on his own core holdings. He has exposure with me. He's invested with me with Kernan Capital, but he also had his own trading portfolio, and he knew the longer-term opportunity that existed when that first few minutes opened. He wanted to step in and buy some shares. So the simplest way of saying this is know what you're getting into before you commit. He knew when the market was trading off, there was opportunity. And he knew, I would imagine if we did a survey, I'm not going to, you've all been so good so far in indulging me, over half the people in the room probably have iPhones. He knew the opportunity. And he knew that it's a solid brand, a solid product, and he wanted to take his position forward, farther. This is only possible by gathering the most relevant data available, which enables us all to make the most informed decisions. Therefore, information is intangible. It's not the information that everybody can read online. It's the tone, the excitement, fear, aggressiveness that you hear on the other line. The intangible is the human on the other side of the phone. Let's be fair. If you call the trading desk, their objective, they're incentivized to make a trade. And that's good. That's the way it should be. You want to have people, you want to work with people that are incentivized to get the best outcome. Therefore, I often say, call your broker. Throw them a bone on occasion, because you never know what's going to come across their desk that you're going to want a piece of. And in turn, you never know what part of the portfolio you're going to want to unload for liquidity reasons or liquidity purposes. Just a few minutes, if I may, on the regulatory environment. We're all very mindful of the challenges in the regulatory environment. We're all probably very mindful of what's changing in the challenges that exist with Basel III. I could go into further detail on the challenges as it relates to hedge funds and real estate back and asset back and investment grade securities. I will limit that because I realize that that could get a bit long, and I'd be happy to have that conversation with individuals afterwards or later this afternoon or this evening as well as tomorrow. But the takeaway, the important takeaway here is I think it's important that we continue to do what we're doing right here and continue to do that going forward. And what I'm referring to, of course, is continue to have the conversations and continue the dialogue with each other. Because the regulatory environment is evolving, it is changing, and it's important to realize who the other opportunities are in the room or in the marketplace, particularly as it relates to your prime brokers, if they are applicable. Finally, I want to touch on technology as a trend. As you can all imagine, when I first started trading, as many of you know, you looked at the paper from the closing day price, and then naturally Yahoo came in and Yahoo Finance became that opportunity for me to start. And Yahoo today is actually, for not being a true financial service platform like Bloomberg or Reuters or CNBC, Yahoo Finance is actually a very strong, reputable place that gets really good information. So I'd encourage you to continue using it if it suits you. I don't have a position in Yahoo, full disclosure on that. Today, we all have technology at our fingertips, and to trade securities, and many people trade securities between sips of coffee. But I find that this approach challenges the very essence of trading. Many of the trades that I place are only after I have a very detailed conversation with management, if possible. Have a conversation with a variety of trading desks to hear what they're talking about, to hear what their concerns are. And then finally, after a deep due diligence period, a process that all of you follow very carefully and closely, then you decide to step in, either for yourself, your fund, or for those that you represent. So in short, I would encourage you to continue to get as comfortable as you can with technology, but not rely completely on technology to do your trades and to do your due diligence. Further, one could argue that technology also provides value, and that value, creates further opportunity. Whether it's to exploit the price of a particular asset, to increase the spread, or simply to increase volume. And so how can I be counterintuitive and say that we're going to increase spread and volume? Well, you can increase spread on the underlying asset, and you all do that. You know exactly what I'm referring to. When I refer to underlying value, I refer to that intangible that exists with the individual that you're working with. From an equity perspective, that simply means getting a piece of an IPO that you may not be able to get in the general market. On the other side, it refers to the comment I made earlier as it relates to having a piece of a portfolio that you'd like or having a piece that you'd like to unload. Some final comments and some final points that I'd like to share is not all information is created equal. Having informed colleagues and a network of professionals at your fingertips positions you for success. And finally, with regards to trading using a system, good traders don't try to predict what the markets will do. Instead, they look at indicators of what the market is doing today. Finally, I hope that my comments and I realize we covered a lot of ground, a lot of different areas. We could have dove deeper in many sections. I hope that my comments set the stage for further conversation in the coming days. I've already had a few wonderful conversations with some gentlemen, and I look forward to speaking with all of you. So I love hearing the feedback on what you're seeing, in particular in your industry, as well as the alternative asset class at large. I'd also like to say I'm happy to be in Tennessee. My grandmother and my father were both born here, and as a musician, it's exciting for me to be in Nashville for the first time, so I plan to see many of you out this evening. I would be happy to take any comments or questions that you may have. Please. Sure. Yeah, it is, and I'd be happy to. So in short, Summit Thoroughbreds is invested in horses, in thoroughbreds, and we designed I'll take one step back. So there's a well-known trainer in New York, Dr. John Kimmel. As I understand it, he's the only veterinarian and practicing trainer in New York, which you would think would be incredibly odd. I still think it is. And he had a Race Dubai hat on when he walked into his apartment next to my wife and I in Garden City. My dad's side of the family had been involved in racing actively through the 1980s, and then the tax code changed, so they had stepped away. And I recognized Kimmel, and I certainly recognized the Race Dubai hat. So I had a quick conversation with him. This was probably 2006, 2007. We started a conversation. 2008 or 9, I started going down to the barn. When I'm referring to the barn, I'm referring to Belmont race track, of course, right in around Long Island, about 8 miles away from where my wife and I live, 6 or 8 miles away. And I was hooked. I saw everything that avid race enthusiasts saw, and we designed a very, very, very unique partnership designed just like a hedge fund. And this is probably why no one else does it. Unlike what some people are used to as it relates to thoroughbred racing, you buy one horse, and then you get all the bills, and then more bills. And then, or you want to diversify, and you get 2 horses. And then you want to diversify some more, so you get 3 horses. So what we did is we put together a partnership that went out and bought 2-year-olds so they could position themselves for the big race, right, the 3-year-old race. And we bought what we call a stable of them and syndicated that out to investors. By holding back a portion of the capital raised, we were able to pay all of the ongoing bills for the life of the horse, and all of the purse earnings were paid the continuing ongoing life of the horse. So for our real estate investors, and real estate investors were our #1 client, they loved this model. For anyone that owns a horse or has been part of it, you know that you get no less than 18 different vendors sending you a bill every single month, and they're never late. We took that administrative headache out. We captured that under the original model. And then to incentivize investors, what we did is we said we will split any profits 50-50. So at the end of the term, when all the horses are dissolved or sold off, if you don't make a profit, your capital has to be returned first, and then whatever profit you split 50-50. So that's the essence of Summit Thoroughbreds. I appreciate the question, especially being so close to Kentucky. I'm just itching, but I know there's plenty of horse farms here in the great state of Tennessee as well. Any other questions or comments? Well, ladies and gentlemen, it's been a real pleasure. I hope that you derived value from the comments that I shared this morning, and I look forward to speaking with each of you in the coming days. Thank you.